very profitable. Now backing up a bit, now why do people form captives? Well, primarily as a way, historically captives were done to reduce insurance costs and improve the risk control. That is why captives have been focused on for the last 60, 70 years. However, there's really a new strategy to tie in potential tax benefits, maybe improving cash flow back into the business for the shareholders, and it's those financial planning benefits that really tie together for the small and mid-sized customers. This is actually a tool where small and mid-sized customers can benefit more so than the large Fortune 500 companies. But a captive is supposed to merge those worlds of risk management and tax planning. That's why folks are doing this transaction. Now, there are a variety of captives out there. Now, historically, the large Fortune 500 companies formed what we call single-parent captives or pure captives. And those were captives that were really designed to insure workers' comp or auto liability, things that tend to be long-tailed because, for tax purposes, they can defer the taxes on those long-tailed lines of coverage. And there are other captives that got popular in the early 80s. Those were group captive programs. Those were really those types of captive programs is what made the captive industry as popular as it is, really more so from a risk management standpoint. Group captives focused on auto liability, general liability, and workers' comp. There are some other specialized group captives out there, but traditionally captives were for the coverages that were high frequency, low severity. That's why captives were created primarily for those lines of coverage. And today we have a unique type of captive called a micro captive or an 831B captive in reference to a specific section of the tax code. Under this section of the tax code, we tend to focus, we don't always focus, on coverages that tend to be a little higher in severity and low frequency. So it's a different type of product compared with the traditional captives that have been done out there for some time. That's not to say we can't insure deductibles and other coverages that have some frequency, but generally when you look at most products that are sold out there in the captive industry, they tend to have very limited frequency, which is one thing that the IRS is looking at closely, and we'll get into more of that shortly. Now, specifically today, we're going to be focusing on what we call the 831B captive. Some folks refer to this as the micro captive or an enterprise risk captive. There's lots of different names that it goes by today. Now, this section of the tax code, which has been around for quite some time, basically states if you form a captive, primarily property and casualty premiums, and you fund at less than $1.2 million of premium per year, then the only taxes that you pay is on investment income at C Corp rates. Why C Corp rates? Because all captive insurance companies have to be taxed at C Corps for tax purposes. In various domiciles, you can call them LLCs and a variety of other types of legal entities, but at the end of the day, they are C Corps. But basically, you're forming a C Corp whereby you're peeling off one layer of the double taxation, and you're only going to be paying taxes at long-term capital gains or qualified dividends, depending upon how you take the money out down the road.
And I would like to add, Brian, I'd like to add for the audience we're talking to, this is black letter law in the code. This is a code section that authorizes the formation of these entities. This is not some interpretation of a tax case from some tax lawyer in New Jersey or Wyoming or something that came up with this idea. This is black letter law in the code that allows and authorizes us to form these. And that's very important. Also important,